Hey guys, how you doing? So Dan from Trading with Dan here. In this video we're going to look at volume. So why is volume important? Right, if you only look at the historical prices of an asset, that only tells you half the story. The other half of the story is the volume, because that reflects the amount of that asset that was traded at each price level. Each volume bar represents how much of the asset was traded in that time period. Volume at certain price levels can tell us if many stop losses were triggered. It can also tell us if there were many market orders triggered at that price. So using that, it can tell us the strength or the weakness of the price movement in an asset. So volume trends. Volume confirms price is a saying that means if the movement in price is accompanied by large volume, then it means there is a high interest in that price move, and as such a higher likelihood that that trend will continue. The opposite is also true. So if a price moves on low volume, then it indicates that there's not a lot of interest in the direction of the move, and it means the trend is not a strong trend and more likely to reverse. So if you kind of think about it this way, say the price is drifting up, there's no real buying going on, no real selling going on, but there's just a bit more buying than selling, obviously. That's why the price is going up, but not high volumes, obviously, of either. Then that's not really confirming a strong trend, and the volume isn't confirming that higher price that its price has drifted up to. So then if we then get actual volume come in, and say that volume starts to sell the price, then that price will then probably move down pretty quickly compared to the speed it was drifting up. Also, if volume comes in and buys the price and then the price starts moving up quickly, then we know the uptrend will likely sustain, because we have a larger basically larger volume, so larger interest in buying at those prices, therefore more likely that the price is going to go up. So here, and we can see in this example that the price is moving up, but the volume relative to the largest spikes in volume previously are quite low. So you can see we've had this large volume on this downward move, and then price has been drifting up quite considerably, like half of the move down from the top, but not being accompanied by a very high volume at all. So that kind of shows that there wasn't a lot of actual amounts of the asset contracts traded at these prices. It was just a small amount of contracts buying, but there weren't very many offers in for them to buy, but nonetheless there were more buyers, even with a smaller level of contracts, and that was enough to push the price up. So as we can see, the price subsequently starts to decline and the volume starts to increase, indicating that there is interest in the downtrend, and as such we can observe a sharp move down from the price with higher volume. So here we got it. You can see we start to get that move up, that drifting up on low volume, and then we start to move down, and as you can see the volume starts to increase to a point that you can see there's clear interest in this downtrend, and this downtrend is sustained because there is a lot more people actually selling this downtrend. So this is an example of price action between two horizontal lines. So this price action here has very relatively low volume, and also the volume stays roughly at the moving average. This shows there is a low interest in the zone, so the prices are really just ranging in this zone. So you can see here's the volume bars, and you can see the moving average is pretty much about where the volume bars are sitting. There's no big spikes up, no high levels of volume like we do have here, which you can see we then have trending action. So, market insight by volume. As a rule, you will find higher volume when a market is trending, as there is more interest and activity in the asset. So obviously when you saw in that first example, when price was moving against the actual original move down and obviously against the subsequent move down afterwards, that was on low volume, so it wasn't really trending the market. That was more of just a retrace or consolidation. But obviously the volume came in when the market was actually trending in its downward move. So during periods of consolidation or retracement, you will typically experience lower than average volume, as there is less interest and therefore less trading activity. Volume levels are different for different assets, so you have to be using a moving average of the volume for each individual asset to define periods of high and low volume. A certain amount of contracts traded on one asset, that average for that asset may be a very high, but the same number traded in a different asset might be low. So say for example you've got like the main S&P contracts, they may trade like millions of contracts a day, for example. Maybe that's an exaggeration, but then you'll get like a contract of like say an individual certain month on the, like say the oil future curves, that will probably only trade like say 500 or 600 contracts in an individual day. So obviously if the oil started trading 1,000 contracts a day, that would obviously be a spike in volume. But similarly with the S&P like E-mini futures contracts, if that started trading 1,000, then obviously that's a massive drop off in volume relative to what it normally trades. Right, so volume spikes. So we have covered the fact that higher volume confirms the trend, but this can also be the opposite and confirm a point of reversal. So what do we mean by this? What we mean is that when there is a large volume spike accompanying a large move up or down in an asset, then that often is a signal that the buying or selling is over and the direction of the trend is going to reverse. So this is sort of like a buying climax or a selling climax. So think of it this way: if all the buyers have bought in a large volume buying climax, that spike of the price higher, then there's nobody left to buy as everybody bought in that buying climax, and certainly not enough people to buy in enough volume to keep price going up. So all that is left is for sellers to come in, and traders who bought will have to take profit, or even if they bought the actual the price spike up, they would have to sell their positions at a loss. But either way, that's selling, not buying. So volume spike types. There are two main types of volume spikes: a breakout and a breakdown in volume spikes. This is the first type: a breakout or breakdown volume spikes. This is when price breaks out of a consolidation zone on high volume, and that would indicate that a trend is likely to continue in the direction of the breakout. And then you get an overbought or oversold volume spikes. This is what we spoke about with the buying climax or the selling climax. This typically occurs at a market top or bottom, or at a resistance or support level, and indicates that all the interested buyers / sellers have entered trades, and therefore indicates the trend is likely to reverse at that point. So hope you guys understood how volume is very important. Obviously price action is only the surface area of what's going on. The volume is what's going underneath, how much is actually transacting at those levels. So if you think about like the surface area of water, like the top of a river, it may just look calm, but sometimes there may be obviously strong currents and a lot going on underneath. Or say you've got the surface area of a pond, it just looks the same as the surface area of a river, not much difference, apart from obviously there's no currents really going on in the pond. So obviously the volume is sort of what's going on below the surface of the price. So there we go guys, thanks for listening to that video, and I'll speak to you on the next one.